So you might be in a position where you're asking yourself, how much of my income should I be investing? And if you've ever asked yourself that, you might have stumbled upon this thing called the 50-30-20 rule. And it's easy to find online, but a lot of times you might be wondering, like, how does that really apply to me? How do I personalize it? So this video is for those of you who want to take investing more seriously, or you're trying to find a better balance of how to do things right that fits you. Hey guys, it's Sun Min and welcome back to Your Money Game, the show where we'll save, invest and feel better about money. Now in case you've not heard of it before, the 50-30-20 rule is simply the ratio in percentages of how you would divide your income and allocating it accordingly. And there are a couple of variations on how they're defined. The first variation that I've seen is a little bit more American. It's 50% going towards your needs, 30% going towards your wants, and then 20% going towards savings and wealth. Maybe it's because we're Asian and we're super kiasu. The other variation that I found more useful was the 50% going towards your needs and wants, the 30% going towards some kind of short-term goal, and then the 20% goes towards your long-term wealth or retirement. Of course, everything here depends on your income and your ability to save. So that's why I feel that the ratios itself are not that important, but it's really the thinking behind the buckets. And that's where we have opportunities to personalize it according to what fits us. Let's start with, why are there two buckets that think about short-term savings as well as long-term wealth or retirement goals? Now this is important because it starts to help you think about this concept of investment duration, which is just how long you invest. It starts you to think about that type of assets you use. Maybe it's stocks, bonds, endowment plans, real estate, could be up to you. And then matching those with the goals that you have. Now I see many newer investors tend to put on this simple mindset where it's, I have a money goal or a time goal and I'm going to invest, and then right after that I'm going to cash out, and they are hoping that whatever they do is going to be successful so they can take their profits and do something with it. But the challenge can happen when the goal is either too short term or it's matched with an investment that doesn't really fit that horizon. The risk is that when it comes time towards your actual goal and you're forced to kind of take that money out, you might be in a position where you have to sell and incur losses unintentionally simply because the market wasn't in your favor at that point in time. And that's why many people still use high interest savings accounts, short-term endowment plans, or maybe even those cash management products that are being offered by robo-advisors today. And I know that the returns of those type of products are lower, but for shorter term goals between 1 to 3 years, they give you that certainty that at least when you reach that goal, you're going to get that amount that you need. And that brings us to the long-term retirement, financial independence, freedom bucket, whatever you want to call it. Ideally, it's something that you can do to set aside for yourself decades into the future. If you're in your 20s or 30s and haven't really considered putting aside such a super long-term bucket for yourself above and beyond the CPF or EPF, here are a few quick reasons why you should consider it. Firstly, we tend to tell ourselves that in the future I'm going to change myself because I'll be able to cut back more in the future when I'm a bit more disciplined. But honestly speaking, we underestimate just how hard it is to change our own lifestyles and expectations because we get very comfortable with certain things and certain lifestyles. Secondly, it's really difficult to anticipate what kind of new needs would pop up and new costs as well. Family, kids, health, and any other additional costs associated to those things. And third, we tend to underestimate just how fast our income will plateau, which is basically like flatline. Unfortunately, statistics show that you're more likely to see an income plateau in your even as soon as your late 30s and even maybe in your early 40s. And that's not even taking into account the potential for any misfortune, such as something like a retrenchment. And finally, we tend to underestimate the power of compound interest. And as Charlie Munger puts it, the first rule of compound interest is that you shouldn't unnecessarily interrupt it. I did an entire video about compound interest before, so if you're interested, check it out. That's why it's ideal that if you can set aside that bucket for the super long term, you just invest gradually over time in it and you don't interrupt it. Let it do its job. But I'm afraid I'm gonna have to interrupt you here to ask you to do me a favor and click on that like button, because that really helps my channel grow, because it tells the YouTube algorithms to share this video out to more people. Thanks. So how else can we personalize the ratio between those two buckets? What are the things that we can think about that help us make that decision? Let's start with the emergency fund. Now, you probably heard about it before, so I won't elaborate too much about it. Make sure you try to get between about 3 months worth of your salary allocated to that emergency fund. Once that's done, you can think about the balancing act between the shorter term needs and the long term fund. You can start by laying out all your goals on the table and putting a cost to them, starting with the shorter term ones. So, for example, you might have that one big holiday planned a year in the future. Hopefully that will happen. And you would likely have the cost, which you can break down into how much you will need to save each month to eventually reach that goal. If your income is good, congrats, you might be asking yourself, why do I need to stretch that goal 1 year in the future? Why don't I just maximize my savings and get it done between, 3 to 6 months? The risk only happens when you sacrifice that long-term bucket for those short-term goals, and sometimes, you know how life is, they just keep throwing new stuff in front of you to plan for. That's why it's worthwhile to keep in mind this good principle of paying yourself first. I pay myself first because I'm working towards that freedom goal, and for me, the way I do it is I'll start with that as the priority goal and then work backwards, looking at the other shorter term needs that I have and how I would allocate cash towards them. But then you might be wondering, I've already got the CPF, how do I factor that in? To figure that out, you will need to try this thing called working backwards from a retirement goal. Thanks to the tools like the CPF retirement calculator, it can be done, it just takes a little bit of effort. But essentially, it involves a few steps. Firstly, it involves you knowing a desired lifestyle cost in today's dollars. For example, just say 3,000. Next is to apply some kind of inflation, because 3,000 today is not the same as 3,000 35 years in the future. Say you're 30 and you're planning to retire at 65. With a rough calculation of 2.5% as inflation, you're looking at a $3,000 ballooning to becoming $7,100 35 years in the future. What? Third is to estimate how long you need that money for. And generally people will plan for about 20-ish years, but for the sake of simplicity, 20 years worth of it would simply mean you would need $1.7 million to cover that period. And fourth, you need to estimate how much money you would have in your CPF in the future. And again, the calculator can spit that out for you. And the final step is simply to compare the two. You have a need, and then you have how much you would have in the CPF. And unfortunately, there's likely to be some kind of a gap. Thanks to your awareness about this problem right now, you will be able to save up more to make sure that the gap is closed thanks to your own personal investment. If your income is good, you might be in a position to consider 3 different things. Firstly, you can take a very super safe strategy by just topping up your CPF, ensuring that you have that amount that you would need to eventually retire comfortably at 65. Second is to aggressively pursue financial independence, which means that you need to allocate much more money towards that retirement or long-term pool. And that's really up to you whether you choose to literally retire early or you just kind of have more options to do something different. The third option is to find some kind of middle ground. And this is where you are already quite aware about how much you need in the future, and you know that you're going to reach that eventually. Just with a little bit of assistance of investing by yourself, you are pretty confident you're going to get there. That's why you're able to allocate more towards your life today and shorter term goals to find more happiness there. And I think for us in society, pursuing goals very aggressively is quite normalized, but I find myself often trying to reflect and asking myself like, hey, money has a purpose, and how is money going to help me be a happier person? And this is coming from personal experience because I come from a family that's extremely frugal, And oftentimes I have to remind myself that, hey, I kind of need to let go a little bit, and life is meant to be lived and not just like blindly pursuing a financial goal. So this last tip is really to consider the happiness for yourself and even for your loved ones around you. Maybe it's money that you're using to pick up a new skill, a class that you enjoy. Maybe it's money for date nights. You can also try and figure out a personal reward system where, say you get an increment, and maybe in the first month that you've got the increment, you tell yourself, I'm going to treat myself to the 50% of that additional money. And you take that, be happy with it, and with the rest you allocate it towards some kind of that long-term goal. And in the pursuit of perfection, as you personalize it, just don't forget to think about your own needs and your own happiness, as well as those of people around you. That's it. I hope you guys got value out of this, and if you did, I would really appreciate your support in clicking that like, subscribe, as well as that bell button, because I'll be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.